But the chartmaster says the lack of highs in some other measures might be a sign of trouble. Carter Braxton Worth of Worth Charting has the charts. In fact, he's got 6 charts, Carter.
Here we go. Let's get to it. First one is the S&P, where it is in relation to its pre-tariff sell-off. So the S&P is about 4% above its high of February before its 21% plunge. So let's take this same exercise and move through various indices. The next indice is the most venerable and oldest of all. The Dow is right back to that high. Now look at the next one, the most popular of all. This is the Mag 7. It is right back to that high, but again, has not exceeded. So this is a big week, not so much for earnings or FOMC or GDP or payrolls. It's do these or don't these break out. Next index, look at the S&P 400 mid cap. Now, of course, it's about 5% below, and is that's the one that's really lagged. And yet, it is one of the best long-term performers since its inception. Has beaten the S&P. And then finally, look at the S&P 500 equal weight. So you have the equal weight S&P is identical to the Dow, identical to the Mag 7, all having recouped their losses and are sitting here, right here today, at those former highs. Do they all finally exceed the high, make new highs, or as the S&P has done, or are we in some other circumstance? My hunch is that if it doesn't happen this week, it's a big telling thing. But I want to speak specifically about the S&P 400 mid-cap. Take a look at this comparative chart. Now, you can only compare something as long as it's been in existence, so this is not an arbitrary start point. It was launched on June 19th, 1991. And you see that the S&P mid-cap has blown away the S&P in orange, and it's also notable that the S&P 500 equal weight, which is the one that's always cited as a problem, right, for a breath, has also blown away the S&P. And in many ways, maybe this recent strength in the S&P itself is just itself trying to catch up with the other two. Meanwhile, it is perhaps the most important week, not because of the earnings, the GDP, or the payroll, or any of the things, or the tariffs. It's because these critical indices will either need to break out here and now, and it's those fundamental macro things that will cause it, or earnings, or put in a double top. My own hunch is that one wants to reduce exposure, anticipating what would be a normal dip, drawdown, sell-off, decline, drop, something that has a counter-trend nature to it.
Carter, it's Karen. So what would indicate that it has broken through? How long, how high above that line does it need to get to confirm that? It's not just a one-day thing, right? What do you need to have?
That's right. I mean, that's right. You know, you'll beat a record. So if all of those were to make a slight new high and then fall 20%, you'd say, see, it made a new high. Not you personally, you generic one would say, but that's not what it is. You need to clear a former high by a certain amount. Now, typically that's 3.5% to 4%, which is about where the S&P is now. And so you need to stick your landing. That's really, if you think about the gymnast that does the fantastic move, and then you either nail it or you wobble. And so nailing it is getting above a former high and staying above it versus faltering and putting in either a double top or what is known as a bull trap.